Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're really good. I hope you've had a fantastic week. Still no Christmas tree up here, still no Christmas shopping done. I am starting to feel slightly twitchy about this. I will get myself organised for the coming weekend, I promise you, which means that next Wednesday I'm going to be sat here saying exactly the same thing. Now, in terms of what we got for you this week, we're going to do our usual roundup in terms of what's been happening with lender pricing changes. I'm going to do a bit of a kind of overview that we do periodically in terms of where rates are more broadly. Then what we're going to do is share with you the latest findings from the Mortgage Works, what they call BTL Barometer, where they've gone out and surveyed lots of landlords to find out how landlords are feeling and kind of what their plans are around being a landlord for the coming few months. We're then going to share a latest bit of news with regards to some rules that have been announced around how you advertise properties, certain information you have to have made available within your adverts. And then we're going to wrap up with question of the week. Now, before we get into that, I actually just wanted to say a huge thank you. So at Mortgages for Business, for those of you who don't receive it, every week we send out what we call our investor update, where we include various news articles that link to this video and all sorts of stuff. And within that, in the last week, we included a written account of my experience of getting back my buy-to-let property from my non-paying tenant. And this has then subsequently been shared by a few other landlord publications and in various landlord forums. And it has been absolutely amazing / devastating, I suppose, as well, just by the sheer level of responses that I've had. So some people have been emailing me just saying, no, thank you for sharing, really sorry that you've had that experience, which is very, very kind of them. But other people have actually been sharing also their thoughts in terms of their experience in terms of getting properties back as well. So there's been some really sad stories in that. One of my clients has actually even sent the article to Angela Rayner in really kind of the view of just, please don't remove section 21 because this is why landlords need it so desperately. So just really more broadly, thank you so much for those of you who wrote in about that. And actually, if you haven't read the article, and I know I've kind of covered the whole sorry experience of getting my buy-to-let back on these videos, but if you did want to read the article, it's available on our website. If you go on there, you'll be able to find it, but likewise there's a link in the comment section below this video if you want to go and have a read. Okay, so another week has passed by where I haven't done my Christmas shopping, and another week passes by where my 5-year swap rates still haven't gone below 4%, unfortunately. As of today, 5-year swaps 4.058%, 1 month ago 4.552. So there is a kind of big step down in terms of cost of funds on the wholesale markets month on month, but alas, the sub 4% mark eludes us another week, maybe next time, hopefully before the end of this year at least. Now, in terms of lender pricing, we have actually still seen a really healthy number of lenders making rate reductions in the last week. So the first one we've seen is Accord Mortgages, who have made reductions of up to 0.3%. So their pricing is now from 4.64. We've seen Kensington release some new limited edition products at 70% loan to value. For 2-year fixed rates are now from 4.19 and 5 years from 4.79%. These do tend to come with a slightly more lumpy arrangement fees, but still relatively competitive when you look at the overall cost from the Kensington. We've seen Aldermore Mortgages make rate reductions. Their pricing now from 4.59. Again, just watch those fees. Capital Home Loans have come out. So they've been very, very quiet for a long time actually, but they've been able to kind of rejig things in the background, and they've been able to bring out some much lower interest rates. So Capital Home Loans now have 2-year fixed rates from 3.65% and 5 years from 5.1%. Again, these lower rates tend to have the higher arrangement fees. They will have a range of products within their suite, as all lenders seem to do at the moment. So low rates, high fees, higher rates, lower fees, and then something sitting in the middle as well. They've also seen the Yorkshire Building Society drop their rates down by 0.2%. So pricing here is from 5.1. The Leads have dropped down by 0.2%. So personal rates are from 5.14 and limited company from 5.19. We've seen Molo win the prize for biggest reductions this week of 0.8%. So their 2-year fixed rates are from 4.65. 5 years are from 5.75%. And then we've seen lastly the Coventry make rate reductions as well. So their pricing is now from 4.87. Now, as those eagle-eyed amongst you will note, broadly speaking, it's still predominantly the specialist lenders, so the non-clearing bank type institutions, who are making rate reductions here. But actually, the reality is that the direction of travel is still downwards, but the rate at which we're seeing lenders dropping their rates, the number of changes we're seeing and the amount they're stepping down by is really starting to slow. And that is purely because of the cost of funds on the capital markets have really stabilised. So I do think we'll continue to see some pricing downwards over the coming weeks. But again, please don't think there's going to be some kind of hallelujah moment or something like that, because there simply won't be, because the metrics, the numbers simply aren't there to support such a change. Now, in terms of how this is shaking out into sort of broad terms, what I've done is I've just taken a £150,000 mortgage. And what I've done is I've tried to find the deals which have the lowest cost over a 2 or 5 year period. So rather than just saying to you, our cheapest interest rate is 3.5 or something along those lines, and it's got a massive arrangement fee. What I thought I'd do is try and find the deal which would cost you the least amount of money over 2 and 5 years. So if you're an individual looking to take a 2 year fixed rate on a standard property, an indication of pricing would be a 2 year fix at 4.98% with a 995 fee. So that would kind of represent the cheapest deal over a 2 year period, taking into account the interest you're going to pay and the arrangement fee. A 5 year fixed rate at the moment would be at 4.83 with no arrangement fee. Limited companies now, so 2 years, 6.79% with no arrangement fee, 5 years, 5.99 with no arrangement fee. And that can kind of show you how essentially the mortgage rates are actually what the cost of borrowing should be. So on limited companies, a 5 year fix at the moment, all in, so interest and arrangement fees, should broadly cost you somewhere in the regions of 6%. In the personal space, it should cost you circa 4.8, 4.9%. That's kind of where pricing sits in the round, taking into account the interest costs and the arrangement fees at the moment. Okay, now I think it's fair to say that it hasn't been anybody's favourite year this year. It has been a bit of a tough one, hasn't it? I must admit, I'll be glad to see the back of it. Obviously on the basis that 24 is going to be better, not worse. So it's really interesting to read the latest buy-to-let barometer, which has been published by the Mortgage Works, where they've gone out and surveyed absolutely loads and loads of landlords to find out really how they're feeling about the buy-to-let market at the moment. And within this report, actually, there is some really positive news. So the first thing to note is that planned divestment has fallen for the first time in over a year, returning to Q3 2022 levels. So essentially the number of landlords who are planning to sell a property in the next 12 months has come down to 28% of landlords. The number of landlords who are expecting to buy in the next 12 months has stayed the same at 8%. So less people are thinking about getting rid of things at the moment. In terms of landlords' confidence, this has recovered for the quarter for both capital gains and rental yields, albeit confidence in capital gains is still lower than this time last year. So at the moment, 24% of landlords are feeling confident about the prospect of capital gains in their letting business. 1 year ago, this was at 31%. At the moment, though, more positively, 49% of landlords are feeling positive about rental yields, whereas 1 year ago, this was 37%. So that's really, really encouraging. Now, the other thing they've talked about, which is nice to hear, is perceived tenant demand. So 71% of landlords have reported an increase in their perception of increased tenant demand in the last 3 months. So I think what we can take away from this is that I don't think landlords are feeling totally kind of like they want to throw a party at the moment, but things definitely feel like they're starting to turn the corner. And I think this is going to be probably attributable to several factors, actually. So first of all, a calming in the financial markets. That's going to definitely help, because when those are unsettled and interest rates are going bananas and bouncing around over the place, that's never going to make anyone with a mortgage feel very, very confident. Secondly, house prices. So house prices do feel like they've probably largely bottomed out now in terms of where they're going to go. For those of you who watched last week, Hamptons were kind of implying in their latest report that they think that we're going to see no growth next year at all, but actually we have reached the bottom of this kind of curve. And the other thing is that rental yields are increasing. So in terms of a landlord, if you're going to get a greater level of income, even if you are faced with higher mortgage costs, this can only be a good thing. So like I said, I don't think anyone's kind of, bouncing off the walls celebrating, but I do think actually in terms of being a landlord, things are feeling certainly more positive than they have done in recent months. Okay, now for those of you who advertise your rental properties privately, this is something that's going to be very, very poignant for you. So landlords are going to have to include many more specific points about their properties when they list them in the future, whether directly or via a letting agent. One would hope the letting agent would know how to list a property correctly. but I guess we can't take anything for granted, can we? So, an initiative from the National Trading Standards State and Letting Agent team, try saying that after a couple of glasses of sherry, is attempting to give consumers the maximum information about properties before viewings and making rental or purchase offers. The measures will complement existing consumer protection regulation from unfair trading regulations introduced back in 2008. This new list includes property basics such as the number of bedrooms and location, but also details of a property's utilities or lack of them, parking, accessibility facilities, flood risk, and many other features currently missing from most ads for rented homes. So-called Part A of this material information was released by Trading Standards last year and requires landlords and letting agents to include council tax band or rate, property price or rent, and tenure information. Now, Parts B and C have been introduced. So Part B is information that should be covered for all properties, such as the type of property, the building materials used, the number of rooms, and information about utilities and parking. Part C is information that only needs to be established if the property is affected by the issue, such as flood risk or restrictive covenants. So really just more, I think, an FYI that if you are putting a property up for rent, there are certain requirements in terms of what you're going to be covering off in your advertising. So just make sure that you don't miss any of those key points. Okay, and finally moving on to question of the week, and 10 out of 10 points to the lovely viewer and also a very good client of ours who sent this one in. So last week I referenced a report that had been released by Hamptons, and saying you should go and read it because it's really interesting. And the lovely client actually did do this and has read it very, very thoroughly and actually come up with a really good question. So the quote from the report was, and for those of you who are interested, it can be found on page 14, another factor that may push up the cost of finance for landlords, the Basel III regulations, which are designed to strengthen the banking sector, are finally set to go live in 2025. These will oblige banks to hold a great deal more capital against lending to portfolio and HMO landlords. So the question from the client was, can I just explain this to you in plain and simple terms? And I'm going to do my best here. So essentially what's going on is there's something called Basel III coming in, which is really kind of essentially putting in place a framework to make sure that lending institutions are financially sound. For every pound of money that any lending institution lends out as mortgage monies, they have to have a certain amount of money also set aside, be it in deposit accounts or other kinds of investment policies, but they need to have capital set aside to kind of offset the mortgage lending. Now, depending on the type of mortgage lending, which is graded in terms of risk, this will impact the amount of money that has to be set aside per pound of mortgage money. So a very, very kind of straightforward, squeaky clean loan would have the minimum level of money to be set aside, whereas something that's classed as very, very high risk would have a higher requirement of money set aside. So moving into 2025, essentially HMOs and portfolio landlord lending is going to be classed as higher risk. And therefore lenders would have to have more set aside per pound of lending on those types of transactions than if it were, for example, a personal name buy-to-let or a straightforward property. So the fallout of this is because lenders are going to have more money set aside to lend on these types of transactions, it's going to push up the cost of these mortgage deals. So that's actually what this is referencing. Now, in terms of how much cost we're talking about here, that's the thing that I think will become more clear in time. But what we have seen is lenders start readying themselves for this. So as an example, Paragon have always offered the same mortgage rates for individuals and limited companies on HMOs and multi-units and non-HMOs and non-multi-units. They've always had one set of products. What we've seen in the last few months, they've actually split these out. So they now have HMO products and non-HMO products. And this is really themselves readying themselves in anticipation of these changes coming in. So yes, I'm afraid for those of you who are HMO landlords or portfolio landlords, limited companies, this kind of thing where the type of lending that happens with you guys is classed as higher risk, you will find that the cost of borrowing will increase. But how that's going to actually look will really be something that comes clear at the time, because it depends on the lender's cost of funds at the time and also how much it's going to cost them to have that additional capital set aside for that particular transaction. But I hope that answers your question. So it's not a straightforward one, but it was a really fantastic question. So thank you very much. And that's us for this week. It goes around quick, doesn't it? And last week will be my final MFB news for 2023. So let's hope we're finishing off the year with a 5-year swap rate sub 4%, or at least that I've done my Christmas shopping. One of the two would be good. We prefer the former, but let's just wait and see. Thank you for taking the time to watch, and as always, if you had any questions, you know you can give us a call 0345 345 6788, and there is, as always, a plethora of information available on our website. Look after yourselves, and I'll see you same time again next week.